In a previous video, I talked about retirement accounts in light of pre-tax money or money that goes into a 401k versus Roth money. And I'm going to add a third type of account to this section too, and that is taxable or non-qualified accounts. And the example of this is if you just go and open an investment account and it's in your name. So it's not in an IRA, it's not in a Roth IRA, it's just in your name. Or you may have a joint account with your spouse. This is what is considered a taxable or a non-qualified account. And there is a place for this. So I want to do a quick review of where we were at before. And I've added another column in here. And this is the idea of being tax deferred. So if you think about it, with your Roth IRA or any of your IRAs or your 401k, you don't have to pay tax on those accounts on an annual basis. While that money is growing, even if you're buying and selling funds inside of your IRA or 401k, and even if those funds have some dividends and interest, you are not paying any tax on that money until potentially later in retirement. That is not the case with a taxable or a non-qualified account. With this type of account, you receive a tax form that's called a 1099 every year. And for any purchases or sales or any distributions of dividends or income or what's called capital gains in mutual funds, you have to pay taxes on those along the way as they, even though the investment is still in the account. But there's a few key differences, and one really big key difference with the taxable account that can make it quite appealing. And that is when you go to sell the investments in that account. So let's say that you purchase investments now and you just stay in those same investments out until your retirement. You're probably going to have to pay some tax along the way because more than likely that investment's going to be generating some dividends or interest that you have to pay taxes on. And that part is usually that level of taxes is usually a very minimal tax. When you go then to sell all the investments and take them out of the account, you only have to pay a 15% tax on the difference between what you paid for the investment and what you sold it for. So, for example, if you bought an investment for $100 and it grew to be $200, you only have to pay that 15% tax on the difference between what you paid for it and what you sold for it. So in that example, the capital gains tax would be $15. That is a much lower tax rate than, for example, with the money that you put in on a pre-tax basis. Again, yes, it is tax deferred, which is great. Yes, that money is also, you do get tax savings on it now. But the downside to it is that when you take it out in retirement, it's subject to ordinary income tax rates. And the whole amount is. So remember, in this one, it was only the difference between what you had bought at and what you sold at. With this one, all of the money gets taxed at ordinary income tax rates. And that tax rate is very likely to be much higher than 15%. So in another one of the videos coming up, I'm going to talk all about prioritization because I don't recommend that you just jump and start to put money into a taxable or non-qualified account. There is a time and a place for it. So I'll talk about this more in the video that's all about prioritization.